We're ready to start. So first of all, good morning, everyone. Thank you for attending. Thanks, of course, always to the DIRK organisers for inviting us to be part of the schedule today. Just to introduce myself, my name is James Tickner. I'm responsible for advisory services, product development at NASDAQ. For those of you that don't know our services, we sell a suite of products and services to the investor relations professionals, ranging from equity and bondholder identification, investor targeting, through to desktop and mobile solutions for the IR workflow. So I'm joined here today by my colleague Shanika Benimadu, who is responsible for our investor targeting practice for both EMEA and Asia Pacific. So we have a fairly packed schedule for you today. We are going to start off by looking at some overall wider trends on the buy side and in terms of investment in Germany. We're then going to talk through some more practical aspects around thinking like a generalist, weighing up pockets of opportunity and risk, leveraging technology, of course, to make more use of the data that you have. And then finally focus on some best practices around measurement. So the session is going to be somewhat interactive today. We have poll questions. So hopefully everyone has one of these on the way in. So we have 3 of those throughout the session, and we'll be getting feedback hopefully pretty much instantaneously. So, and then of course we will leave plenty of time for Q&A at the end. Okay, so starting with the trends, we wanted to kick off with something that actually we've spoken about at DIRK before in the last few years, which has been the rapid growth, of course, in the assets within exchange-traded funds, within passive investment vehicles. This growth has been fairly explosive. You know, the AUM now is estimated at over $3 trillion. You know, some of those household names, who I'm sure many of you know from shareholders that you already have, names like Vanguard, saw significant inflows in through last year. Of course, BlackRock, State Street, and Mellon, you know, the cases are similar across all of those. You know, what's really been interesting about it has been actually looking at how then the active buy side, of course, the investors that a lot of you will be talking to, how are they reacting? How's it affecting their businesses? And of course, in a lot of cases, you know, some of these key names are suffering a bit in terms of redemptions. It's been a struggle, frankly, for a lot of them to really, you know, justify the active management fees and beat their benchmark performance, particularly given the differential between the cost of some of these passive investment vehicles. So some of the names, a couple of examples we've highlighted here. Northern Cross, you know, again, suffered some fairly heavy redemptions along with Aberdeen. But what's interesting is when you look at it, the obvious next question is, well, when you look at the active buy side, how have they responded? How have the stock pickers responded? Are they doing anything differently? Where are the pockets of outperformance? Now, there are certainly some of the more household name funds that are doing pretty well. Some of the Capital Group American funds are doing very, very well currently. But there was a report by S&P that highlighted actually some of the characteristics of the funds that are doing well at the moment, are attracting new money to put to work in equities. So a couple of characteristics stood out to me. One was they found that funds with higher active share, if anyone doesn't understand active share is the degree to which a fund invests outside its benchmark weight. So if there's a company in its benchmark index that is worth 0.5% and it invests 1% of its assets, that's obviously 100% overweight, but it also counts for stocks they hold outside of their benchmark. So say their benchmark's against the S&P, and for example, they invest in a German company, that will also contribute towards that. So they found that funds with the higher active share were faring better, both in terms of overall performance of the fund and also in terms of new money in inflows. You know, what's obviously interesting about that is it really points towards the stock picking nature. So essentially managers that are really justifying the active management fee by investing, you know, not as a closet indexer, as they say, taking, you know, slightly bigger bets, overweight positions, holding for the long term. In many ways, really sort of classic value investing, in fact. So it's not just been the long onlys that have been affected here. I wanted to just highlight some data on the hedge fund community. On the right-hand side here, you can see assets invested in hedge funds going all the way back to 1997. What's interesting is towards the end of the chart, you see in the last couple of years, 2-3 years, assets have really been creeping back up to that high seen in the late 2000s. But most recently, and in this most recent quarter, the Financial Times just ran this, the biggest value of redemptions from hedge funds in Q1 of this year, back since 2009. So they are certainly feeling the pinch in some ways. So again, like obviously the question is, what are they doing anything differently? How are they reacting? We have seen a few examples of hedge funds extending lockup periods, so keeping their investors locked in for longer periods of time. We've also seen some of them redress the balance between outside capital and partner capital. I think there's a couple of examples of funds that have actually gone completely the other way and given all the external money back. So to just try and stabilize themselves and give themselves obviously more flexibility in the market so that the redemptions aren't affecting their holdings. Again, so activism remains in the headlines. This topic has been talked about at length by many far more qualified people than me recently, so I'm not going to do it to death. But one thing that was interesting that we have noticed has been the likes of the names I mentioned earlier, the State Street Global Advisors, some of the largest passive managers, which quite honestly pretty much everyone has in their shareholder base. We've seen them increasingly willing to partner with activists around certain resolutions. So if there's a holding that is lagging the index and dragging it down, we've seen them very happy, and obviously they often have extremely sizable holdings to put to work in a voting capacity. Just so something to be aware of. Sovereign wealth funds, again, we'll see actually in a short while just how significant the role is they play in German equities. But of course, and again, many of this was well publicised. I think towards the back end of last year, the troubles that the sovereign wealth funds were facing, particularly those dependent on oil, of course. Many of them, of course, were taking back external mandates from some of the the investors that you all know across Europe and in the US. So some examples here, UBS, Mellon Capital, BlackRock, and MFS, of course, well-known funds. And then interestingly, and again, this is more recently talking about Q1, and this is really the first we've seen of this. There's been Norges Bank. The government has started to withdraw money from that fund in Q1 2016. Now, in reality, I mean, certainly the data we're going to look at shortly shows that we haven't really seen that flow through much to German equities yet. We may do in the next few months.
I think they are flat overall in terms of flows because they have seen inflows in terms of dividend. So that's counterbalance some of that withdrawal of money from the government.
Yeah. So we'll be, of course, watching that in the coming months. The other thing I wanted to mention around sovereign wealth funds and how their approach is evolving has been many of the funds, particularly in Asia Pacific, that have traditionally outsourced a lot of their management and really taken quite a hands-off approach in a lot of cases. Really two trends have emerged there. The first one being that they're increasingly taking management responsibility of that in-house. And the second one is increasingly becoming more global in their outreach. So actually looking to increase exposure to global equities and also to have more control over the investment process. I think some of the examples we've noted here may be known to you. So there's Korea Investment Corp, Kuwait Investment Office, and then two funds actually in Malaysia, interestingly. I know a number of companies we work with have been Sea Employees Provident Fund, Bank Negara, in the last 18 months. So some interesting new names coming up. Of course, the other one is in Japan. Their government pension fund adopting a more aggressive approach, and essentially it plans to increase its exposure to global equities, primarily through sub-advisors, but still that's money flowing into the market, and the size of the fund is enormous, as you can see, the 1.1.
And BlackRock is
$1 trillion.
supposed to be, I think, the biggest winner of those inflows. So, so that is interesting, of course.
Yeah. And then just one more, while we're on the sovereign wealth fund topic, to finish on SAFE. You know, China SAFE is probably the one example that bucks the trend we've seen across all of the other ones. It really does go from strength to strength in terms of holdings across European equities and, of course, in Germany. And I think we'll look at some data on that in a second. Okay, so just wanted to show some data here on the German market holdings here. Here we're looking at data aggregated across our German client base. We're looking at holdings geographically over a 3-year period, so early 2014, 15, and 16. You know, first thing to say is, of course, international investors clearly extremely prominent, still accounting for 85% of the free float across German companies. You know, overall the picture is fairly flat. Obviously, probably the two things to note is obviously the US investment came down slightly over the course of 2015-16, and then in the UK obviously a slight bounce up over the same period. One thing to mention about the US, of course, is still, you know, everything that we see and hear anecdotally points to obviously the focus of German companies being very, very high in the US, leveraging the Extel We Convene survey from last year. Unfortunately, we're too early for this year's results. So still almost every German company that participated in that survey is traveling to the East Coast regularly for meetings. So let's look at some of those names again. So a couple of interesting things when you look at the top active holders. So again, we're excluding the passive and index names that, of course, will be prevalent everywhere. When we look at the buyers, I think a couple of things stick out. Of course, I mentioned China SAFE going from strength to strength here as one of the largest buyers. What's interesting is really only one US investors in the top 10. So looking at MFS there in Boston, a few London names, and also a couple of more tier 2 investors, people that you maybe wouldn't expect to see in this list. A good example being there Flossbach and von Storch in Cologne. Okay, so we wanted to just talk through again, like we obviously get so many requests and companies asking us about the US market, particularly which locations to go to. As we saw earlier, it's, you know, almost everyone is doing the standard northeast markets, of course the key players there. But, you know, there are other opportunities for European and German companies. You know, the questions that really need to be asked, of course, are things around obviously the sector that you're in, but also the financial profile that you have. And, you know, different markets will fit very well with particular sectors. Obviously, in the West Coast, there are a lot of technology funds. There's a lot of growth funds. In, you know, the Midwest, there's a lot of investment in European consumers. So there are some really interesting names in these markets. I think the most important thing is to take a very personalized view of the US market. So the answer will be very, very different depending on the profile of your company as to where the right markets are to go to. Okay, so this is the first time we get to use this thing. So fingers crossed. So again, staying on the geographic theme, we want to know which geographic market you see the most potential for new ownership in your company over the next 12 months. And while you're answering that, we're gonna swap around here.
Yeah.
So it's open?
It's open.
Okay.
Great. Has everyone voted?
No.
We're waiting.
To press this first or no?
No, just the number 1 to 5, whatever you think. Number 5? No. Okay, I think it's.
interesting. The US.
Yeah. We nearly always see the US as top, but it's interesting to see Asia so high, actually.
Yeah. But Germany still has a high number. I'm surprised by Asia Pacific. But,
Yeah.
you know, there's definitely some opportunities there in terms of sovereign wealth funds and other institutional money in Japan. So, great. Excellent. Okay, my name is Shanika, so I'll be talking to you about targeting and balancing risks and opportunities. I think before you think about targeting and before you do think about your targeting strategy, I think you need to think how investors view your company and how you're competing for capital. A lot of our clients and companies tend to do a peer analysis when they're looking for new pools of capital and new opportunities. But beyond the sector analyst, there's obviously a whole generalist pool of capital that is available to you and your company. In terms of how investors screen for companies as part of their investment process, they're viewing companies in different ways, right? So not only looking at your sector, but they're also looking at your fundamentals that are specific to your company in terms of your valuation relative to your sector, your growth prospects, your yield, also company-specific factors such as if your company has an SRI focus, also looking at the macroeconomic environment in terms of European-wide, and also the geography and political environment and regulation in your country. So that is very important when you're thinking about both risks within your existing shareholder base and also opportunities within and outside of your shareholder base. So another poll question. So in your investor outreach, how do you allocate time marketing to sector specialists versus generalists? So are you spending more time with sector specialists, around 50-50, more time spent with generalists, or you're unsure in terms of the people that you're meeting with at the institutions? Yeah.
The numbers are ticking up, you see.
So we can see who's voting and who's not. Okay, wow. So that is interesting. So people might spend more time with sector specialists. So on the next few slides, we are going to see, the importance of generalists and why it's important to actually understand who represents, the best person for you to meet with at the institutions you're interacting with. So if we look at some mutual fund data in terms of sector-specific and generalist funds, we can see that the non-sector specific funds are actually 8 times bigger compared to the sector-specific funds. So that represents a big pool of capital that companies generally tend to ignore, and especially if you're focusing just on the sector funds and on the sector analyst at institutions.
Just to say that, I think it's really difficult, obviously, particularly when you're bringing, your management out to meet with investors, for example. There's a natural tendency towards, obviously, people that know the dynamics of the industry, know the competition, know the story. But it's interesting when you actually look at the volume of assets that are available in these more widely focused funds.
Yeah, and we are going to go through some other slides and talk about the people and how to identify the people at the institutions. So the first step is to think like a generalist and how they are screening for companies as part of their investment process. It's important to make the distinction between competition for customers and competition for investment capital. If you're a BT and a Sky, you're competing obviously for customers, right? But you're not necessarily competing for capital because again, although your sector is the same, but your investment profile for a generalist might not be the same. So here I have a snapshot from Credit Suisse Holt lens, which I'm not sure whether you're familiar with, but it's widely used by the buy side as part of the screening process, the first step to screen for companies to put in their investment portfolio. So it's important to define your financial risk and return profile, and also try to uncover an extended peer group, which at NASDAQ we call a fundamental peer group, which are companies that share similar fundamentals to you in terms of different metrics. Here on the screenshot that you can see, we have a universe. So here is United States, but you could look at it from a global perspective or European perspective. And if you're smaller cap companies, you obviously would want to compare yourself to other smaller cap companies. I think this is important. And also think about other characteristics that are key to your company and that underline your company, and how generalists would normally think of your company as. So metrics could be around dividend yield, sales growth, your valuation in terms of your P, your relative P versus the sector. So all these different metrics, I think in that way you can then uncover an extended peer group, and what that will do, it will help validate the targets that you're looking at, and also uncover the generalists at the institutions that you're considering. So that is very important. And the next step is, once you have identified the institutions, what about finding the people at the institutions that you would like to meet with? Here, I think we take an example of the top 10 actively managed funds by the inflows, which have 15% or more invested in Germany, and we can see that most of them are actually non-sector specific, so which is actually very interesting. I think the distinction to make here is, if this fund is relevant to me, should I meet with a fund manager? Is he ultimately the decision maker? Or is it the sector specialist that is influencing the investment decision behind my company? So making that distinction and having that information from your brokers is key. And I think as companies road showing with your brokers, it is important to get that information for you and for your management team before you go into a meeting, and making sure you're tapping into the most potential for your company in terms of pool of capital. And I think it is very key also to have, I think once you have your targets in place, to understand, to have a framework, right? That will make the measurement aspect, which we'll go into later, easier in terms of setting a framework of priorities and allocating access accordingly. You can see here that we actually split the targets into two buckets. We have holders to maintain, which is your risk side, and then we have the targets to develop, which is the opportunities side. The risk side would be your existing holders who actually have little to no upside in terms of investment potential, or they exhibit some risk characteristics which you may have on your radar. Risk could involve, for example, they're already selling a lot in your stock, they have a bearish view on the sector or on the broader industry, or they're experiencing redemptions, for example, which would mean that they could be at risk of reducing their exposure to you. So this is the risk part, and then the targets to develop, these would include existing holders that could buy more into your company, especially looking at specific funds that maybe you haven't considered before, or other people that are behind other funds that could be relevant to your company. And also looking at the non-holders, right, who are either invested in your peers, would be attracted to your fundamentals, or investing a lot in Germany, for example, or whatever else. So having these two categories helps you understand where the upside is and also where the risks are. And then allocating them a rank helps you when you're going on the road and when you're thinking about priorities. So rank 1 here would normally warrant a one-on-one with management. A rank 2 is usually more of a moderate priority, and a 3 would usually be an investor you would put in a group meeting. And it's also important to distinguish the firms that are more index quant and passive, so you know you cannot influence their investment decisions, although from a corporate governance perspective, it might still make sense to interact with them. So having this framework in mind will actually make your life much easier, especially when we go into the measurement component.
Yeah, it's interesting actually thinking about practical applications. Companies obviously have many different iterations of this and versions of it.
Yeah.
One thing that people often say to us that's really helpful is just particularly when you get a request directly from someone on the buy side, unsure whether they warrant management access. Of course, if you've gone through this process, it's much easier to say yes for sure or no or maybe at some point in the future.
Mm-hmm. Yep, that makes sense. So now we'll go into the measurement aspect and especially around the activity that you'll be doing in terms of your meetings activity around conferences and roadshows and tracking that. So measurement becomes easier, of course, when you track your activity. I'm sure most of you do that, but I have indeed met some companies that don't track their activity. And the way to do it is, I'm sure you have different ways, but the easiest is probably to run it on a platform. And also have the details around your meeting's activity, around the meeting type, was it a one-on-one, the participants from the institutions that you met with, but also from your company. And very importantly, also the key topics covered that will help you also prepare for your next meetings and also advise your management team, what are the key topics they're especially interested in. So that is very key. And that will also make your reporting easier, especially when you have to run a quarterly record of your meetings and what you have been doing. And this will act as a solid basis for the measurement and analytics, which I'll show onto the next few slides.
Yeah, we've actually seen examples of companies that are really going back over a lot of the historical data and prescribing a methodology to capture all of it. Because obviously, yes, it serves well as a way of just recording what did we speak about the last time we met, but also can actually form the basis of analytics and data that could really help you actually make better decisions on which events to do in the future.
Mm-hmm. Yeah, great. Okay, so now we're moving on to the measurement aspects. So we just covered the framework in terms of how we allocate a rank and a priority to the investors. So on a quarterly basis, our suggestion is to obviously track how many of those targets you actually met with, in what format you met with them, and who met with them from your company. When we think about measurement, there's three components that we usually speak to our companies about. One is reach, in terms of how well you're covering these targets. One is alignment, which is who you're giving access to in terms of your company, management or IR. And the third component is outcome. So at the end of the quarter, are they actually buying my stock? Are they selling? Or have they not acted at all? Are they buying my peers? So the outcome is probably sometimes, more often than not, it's outside of your control. You can't control whether they're going to buy or sell. It all depends on what, what stance they have on your company, on your stock. But what you can control is the reach and the alignment, and making the most of that is very important. So having that measurement in place will help you have that structure and also focus your efforts, where needed for the next quarter. You can easily change those ranks and those actions, all depending on what the outcome was for the quarter. And also it's important to look at what they are doing in terms of your peers, right? So I met with, say, FMR 12 times, they had access to management on a one-on-one basis, all those 12 times, but they didn't buy anything in me. They instead bought, 4 of my peers. So should you give them access again for the next quarter? And that is a question that you can easily, answer, having all that information in front of you, especially when you're planning your roadshows for the future.
Just a word on the outcome side of it. Obviously, that's the hardest bit to do. I mean, the idea that obviously tying meeting activity to very specific buying activity. There's obviously many different factors.
Yeah, there's different metrics.
There's different metrics, of course, but one thing that is really important, I think, a lot of companies want to tell those stories around successful engagement. So, meeting with IR initially, meeting with management, subsequently taking a position, in order for them to continue to obviously devote the time they do to meeting with investors, but also growing that.
Yeah. So I heard in the session, in the main presentation this morning, there was some chat around big data, right? I'm not sure whether you went to this session, but we are doing a lot of work on that. And here I'm showing an example of an assessment of some roadshows and conferences, and how we aggregate all the data and look at it from a bigger picture. So what we have done here is actually, if you were to look at the GS conference, which is the small bubble here, sorry, I don't have a pointer, and look at the median profile of the investor that you met at this conference in terms of their investment horizon and their purchase potential, that gives you then an idea on aggregate, how this conference compares to others, right? If anybody is not clear about that, let me know. So if we were to just look deeper into the Goldman Sachs conference here, again, this is all dummy data. You can see that the median profile of the investor you met at this conference was a shorter term investor with small purchase potential. So it could be that, the type of investor that you met at this conference was mostly, shorter term hedge funds. So this, on aggregate, it gives you a good picture of which events you should be reassessing, others that you should probably be attending again, and others that you should have a closer look at the details. The bigger picture helps you compare one event to another from the same perspective, but it is essential to also go into the details and assess the different events from different perspectives too. For example, the location of the event is very important. I think an Asian conference or geographic conference might not, be the same as a sector conference. It's important to also consider the general audience that's going to be attending the conference and who you're actually getting access to. And also how the quality of an event may have evolved historically. So maybe the Goldman's conference was better in the last few years, and this year it was more hedge fund heavy. So it's important to have all these assessments before you make your final decision. But this just shows the application for both big data and also small data, and some of the analytics that you can do behind that to make better decisions for your company. And especially from a time, budget, and opportunity perspective, the bigger picture often helps. Great, so we're coming to a final poll question. So to what degree do you analyze historical missing information as part of planning your investor outreach strategy? Never, rarely, quite often, or always?
It's 7%.
Yeah, I mean, who's among the 7%? I want to know. No, it's interesting. I'd actually would have expected more in the always category. It's interesting that more than 70% don't actually do it more often. I think it is something that you can implement easily through using a platform or even in Excel, and just use it to plan your future outreach and your strategy. And it's very important to look at the different metrics. So yeah. So we'll move on finally to some key takeaways before we take some questions. James, do you want to?
That's
Okay. So I think the key takeaways from our presentation is around, it's very important to look from the eye of the investor and see how they're viewing your company. And the first step to doing that is understanding who your shareholders are, why they're invested, so how they're viewing you, and how, what's the split in terms of geography and investment style of your company. I think that this helps you assess how the investors are viewing you and from what perspective. And also track their momentum, right? So see what they're doing in you, what they're doing in your sector peers, what they're doing in your financial peers. That is very key. And the second step is consider a global institutional universe, as James spoke about. Think beyond the household names and assess opportunities and risks from different perspectives. And based on the targets you have identified, define your marketing strategy and your priority markets. So allocate a rank and time to accordingly to the markets and investors based on the priority level that you have allocated to them. So having, as we have shown before, a target framework for your targets and for the different virtual locations will make that process much easier. And tracking your meetings data, as we have seen, not all of you are doing that. So very important to leverage either a platform or even do it in Excel to track your interactions in detail in terms of how many meetings are each investor getting, who's meeting with the investor from my company, and also what's the momentum in my company and also in terms of the peers. And finally, do measure, once you have your tracking your interactions, it will make measuring the effectiveness of your outreach much easier. And that will help, of course, in planning your future strategy. With that, we are open for questions.
I think we have some time for questions.
Yeah.
Have a microphone over here.
Any questions or comments? Great.
I don't think I need a microphone. It's for the left, yes. Okay. Yeah, you mentioned at the beginning that you.
Yeah, it's okay.
You mentioned at the beginning that you expect more or see more demand from sovereign funds in Asia Pacific, and people also expect more potential in Asia Pacific. But we've also seen a trend that a lot of these funds, be it from Japan or Korea or Malaysia, are actually managed outside of London. So the question is, where would you actually, how would you manage your targeting? Where would you go in order to meet the right people who actually make the decision for the funds?
So I think there's a couple of bits to that. So I think what we talked about was the stated desire of a lot of these funds to take management away from external advisors. Now, as part of that, they then also need to provide access and actually meet, a place to meet companies. So we have seen, I think there's some examples of China Safe opening an office in North America. Obviously people like Government of Singapore already exist in London. So I think you'll see something similar from some of those funds. I mean, it's still early days with a lot of them. I mean, certainly the ones that we talked about, with the Japanese fund, that will be through external advisors, but that's obviously just new capital coming into the market. So yeah, I think you expect to see some of the regional offices. I mean, it very much varies fund to fund. We did talk about the Kuala Lumpur examples in Malaysia, and I can think now of a couple of companies that have actually been to visit them out in KL, so and that was really their only option. So it's a bit of a mix, but we do probably expect that as those become more global in their outreach, they will start to open more satellite offices in some of the key financial centres. Shall you have some?
No, I think that's
More of
Yes.
showed. What exactly is the data that is being analyzed here, and is there some more emphasis on some factors over others, or how's the data compiled?
So you mean the conference picture that I showed before?
Yeah, exactly.
So this will look at, say, your meetings data in terms of the roadshows and conferences that you have done. And basically, for example, again, I'm taking the Goldman's example here, but it will assess the one-on-one and small group meetings that you had at that conference, and then taking the median profile of the investor based on your meetings data and who you actually met with. So what it doesn't consider is the general audience that's there, and that's why I highlighted that, and also, you know, the location of the event and the, you know, the reputation and how the quality of this has evolved historically. So it will be based on, again, your data, but then you can look at it from a historical perspective to see how this has evolved and whether it still makes sense to attend that conference or not. And to tap into different pools of capital, you obviously want to attend different types of conferences, obviously depending on your company, but not only looking at sector conferences, but there might be some geographical conferences in Asia or into the US, and you might tap into more of the generalist pool of capital that we have spoken about. So you do have to look at the bigger picture, but then look at it from different perspectives, and also at the small data and at the details. So that is very important.
Just to add on to that, you asked about some of the data that goes into it.
Yeah.
Yeah.
So for example, how would reputation be measured?
So reputation is more of a qualitative factor. So it would be, you know, your assessment of the conference, and I think we have, all of you as IR professionals or management, you do have a view on the reputation and the type of investors that are attending there. And in terms of the interactions that you're getting, both on the buy side, the sell side, and also peer-to-peer interaction. That is very important. That's how you look at, you know, the value that you're getting from an event.
Yeah.
But then looking here in terms of, you know, the data that we're using to assess it, it's based on the purchase potential of the investors and the investment horizon, which are data that you can get from investors' profile from any platform, for example.
Yeah.
Yeah.
It's just
Is that an automated analysis on NASDAQ, or is that just
This
an
is-
example of what is possible?
This is what is possible, but we can take it to the next level, and this is meetings analytics from what we're producing at NASDAQ.
Yeah, just to say in terms of the metrics, coming back to that, I mean, we've seen companies look at this a number of ways. So this is purchase potential, like how much could they own versus investment horizon, how long do they hold it for? You could do that with holdings, you know, investment in peers.
Yeah.
We've seen it done a number of ways. We've also seen it done outside of just conferences, right? These can apply to investor
Roadshows.
events, like
Yeah.
roadshows could be on there,
Yeah.
people put them on.
Yeah, roadshows are there as well, and you can see we just put all the events in one category and then just assessing the different events from one perspective here.
Yeah.
Yeah.
And I think, you know, historically it's been evaluation of these events has been a purely qualitative process. So you have to retain some of that, right? Like, how did we feel about the conference, the conversations that we had, the people that we met? Of course, that's always going to be valuable, but it's also interesting to have some data alongside it to help with those decisions. Yeah. So I think I saw
Great,
a
we
question
have a
over there.
question.
Well, I have a question on this chart in particular, because when you talk about investors, what do you mean? I mean, when we talk to investors, we talk to sometimes really large investors, you named them already,
Yeah.
Allianz, BlackRock, etc. And then we talk mostly to the buy-side analysts. That's probably very specific in our industry, because we are an insurance stock, and generalists do not talk too much to our management, because, well, probably the kind of business model
It's a bit
for
more
some of them
complex
a
for
little
them.
too difficult.
Yeah, it's complex for them. Yeah, I
And
get it.
and so when you talk about investors, there are, from my point of view, a lot of different investors which within one investor group, like BlackRock.
Yeah, exactly.
And how can you measure, is it the short-term orientated or long-term what is the purchasing power, etc. Do you do that by individual persons or funds, or do you do that on a more aggregated basis?
We can look at it from, I think, both perspectives. At NASDAQ, we do have a view on both, actually, on the institutions. This is institution-based, but we can do it on the funds and also on the people. We do have visibility within BlackRock, for example. This PM is more short-term driven, and he has a preference for this sector. He has a preference for this type of fundamentals, you know, cheaper stocks, paying above market yield, or whatever else. So based on that, we can look at it from different
I think always the issue, just quite frankly, is the relationship between the pots of money, the funds within an institution like BlackRock, and then the people that manage directly and influence. I think it's the influence bit that's most complex.
Yeah.
Because you talked about sector specialists and, you know, those people that are actually, they're not tied directly to a fund in some cases, but they influence across a lot of them.
Yeah.
Those can be harder. I think, you know, you have to really at some point to do this kind of analysis, tie it to funds. So with the PMs and things like that, it's much easier. I think with analysts, you tend to go back to the institution level because it really, it's impossible to quantify. It's just very different in every institution. You know.
And as I mentioned before, you know, even sometimes you see a fund that is relevant to you and the fund manager does not actually meet, right? And it's an analyst that is influencing the decision for your company as part of that fund. So it's important to make that distinction, and that is an information you can get, I'm sure, you know, from your broker or by working with an IR consultant.
I have a question to one of the first slides where you showed the shareholding or the investor basis of German stocks. What exactly is the database for that, and how much percentage of shares actually outstanding do you cover?
So the data for this is the German companies that work with NASDAQ for shareholder analysis. Patrick can give me the number for that.
About half the DAX.
About half the
Many
DAX.
of them DAX.
Many of the MDAX. I don't have the exact number.
So about
right,
50.
No, it's about, I think, 26 companies on this, 25 companies on this list, yeah.
Because we kept a consistent group.
Yeah, we kept a consistent group. And this aggregates all the data, and then we look at, over the last 6 months, you know, who's been the top buyers, sellers, and how the geographical split, what the geographical split is.
And how much percentage of shares outstanding do you cover? So it's 70 or?
That's a really difficult question to answer, just because it will vary.
Average, yeah.
Yeah, I don't know. Patrick works
This
closely
is based
with.
on free float.
Free float.
Free float of each company, so
Yeah.
or we can take it offline, but it excludes, for example, strategic or retail investors
Yeah.
that obviously
Yeah.
would skew this data. So it's just looking at free float
Institutional money.
institutional only.
Yeah.
This data.
Yeah.
You were making a point that it would be a good idea to address more general funds.
Yeah.
But I think that's probably just an option for the larger corporations who have a certain market cap. If you're looking at the really small and micro caps, it's perhaps not an option. And how do you handle these? Would that still be your advice to do meetings with more general funds also, or address a little bit more the sector specialists, because they might be an option to even get into that sphere where small and micro caps are
So
not yet.
Would you say as a small or micro cap company, would you normally meet with only the sector specialists, or would it be small and mid cap people?
It would be more the sector specialists,
Sector
especially
specialists.
for the micro caps who are just starting on the capital market.
So I would say we actually do work with a lot of small and micro cap companies as well, and we find that there's a lot of small and mid cap and other generalist funds that would actually invest in them. And if we look at specifically at the US where we were before, I think, especially for small and mid-cap companies, you do have to make the distinction here of where to go and where the small cap funds are based, and what's their threshold in terms of market cap that they would look at. We find that in the Midwest, on the Northeast, on the West Coast, there's a lot of small cap funds, like generalist funds that will look even at below 1 billion or 500 million market cap. There are some actually specific small cap funds and small cap generalists that would actually meet with smaller companies. And offline, I can give you some examples of that. Yeah.
I definitely, I mean, I see the same thing. I think there are actually a lot of generalist portfolio managers within smaller, particularly that SMID group, right? That smaller mid-cap group. So maybe not extending necessarily. I don't know quite how small we're talking about in terms of the micro caps, but that does exist as a category that we see quite a lot of assets in.
Yeah. I have a list of small cap funds here, so I can give it to you. Any other questions or comments or feedback? Great. Well,
Thank you.
Thank you very much.
Thank you
again.
for listening. Yeah.
Thank you.